We've got GDP and jobless claims numbers coming out tomorrow. Two big factors that the market is looking for, what the Fed is looking for as well for their policy decisions. So let's talk about what do we expect jobless claims numbers are going to be, first of all.
Okay, so in the last print, so last week's print in continuing claims, we saw basically a sideways print, right? We came in line with the last week's print. So the last 2 weeks have been consecutive in their pricing. And the reason we're looking at continuing claims is real simple, right? Uh, the continuing claims are showing us how many people are basically continuing to claim unemployment. Not just not one time claim. They're on the they're continuously claiming.
So
As
they're
the title,
longer term unemployed.
right,
And
right.
which line is that? Just to clarify.
That's the orange line. That's the orange line. And
Okay.
then the white line is the unemployment rate that's reported by Fred. So let's look at the lines. They move not the same level, but they move in tandem, right? As they go up, they'll go up together and they'll go down together. Now, it's important that we watch the continuing claims because they're going to move before typically the unemployment rate. The unemployment rate does move because the continuing claims are released earlier than the unemployment. The unemployment's released once a month, where continuing claims are released every week. So ideally, we'll start to see a move happen in continuing claims before we see this unemployment rate rise. Now, the reason the Fed is watching this is real simple. They want to see the unemployment rate at least double where it is right now. Okay, they keep talking about labor market being tight. Obviously, we are. The labor market, the unemployment rate is at where it was going into COVID.
Right.
Continuing claims are where they were going into COVID. In 2008, continuing claims hit 6 million, right? Even in 2001, the .com, they hit 3 million, 3.8 million. We're at 1.67 million. So I'm saying, look, continuing claims could probably double. The unemployment rate could probably double. And that would really get the Fed thinking, man, maybe we did enough here and employment's a little too loose now and we could start worrying about quantitative easing.
Right,
But
because
until
at the
that,
end of the day, that's what matters. If people are
right,
not making money, they don't have jobs, inflation cannot persist. People can't afford higher prices, so prices stop going up. And that's why they're looking
exactly.
for this to base their policy decisions.
Yeah, and we've yet to see any type of substantial move here just yet. But let's see what happens.
Yeah, let's go over GDP. So we've got that coming up tomorrow as well, which is going to be huge. The market will definitely move. What are we thinking
Yeah.
for GDP?
So I'm thinking GDP likely comes in line. So the estimate's for 2.9%. As you can see here, this is the Atlanta Fed GDP now. Their GDP now tool is like their nowcast tool for GDP, and we're just under 3 as of December, as some point in December here. I think it's December 5th, 10th or something like that. We're just under 3, so we're going to get those numbers tomorrow, and we'll see if this lines up. So estimates here on the where the forecast is also for, like I said, 2.9. So we'll see. I think that comes in line, but I don't think the market's going to have the best reaction to it, even though it's just in line. And this is why. So if we look at a screenshot here of the system, and I put this on Twitter earlier this week, you can see over here on the right, okay, these are every week that the system prints its data. And on the left, you can see the regimes for which these probabilities are stated for. Now, earlier this year, or in the last month, excuse me, we had this period where we had this inflationary or quote unquote risk on spurt, but it wasn't really confirmed because the indexes did not move in favor. So think of the system as double weight, having checks and balances. So it's got a double edge to it. Each one has to line up, otherwise, it's not valid. And what we saw this inflationary pivot last month, but the market wasn't lining up. The data was lining up, but the market wasn't. So it wasn't, as a
Well, the
regime, it didn't
data
line
was
up.
also weak, right? It was only a
Yes,
system strength of 17%.
exactly. And
So
that's
it
another
was
reason.
weak. but
Right.
that was driven by growth.
Right. And since then, that was driven by growth. And since that driving growth a month ago, it's fallen off a cliff. That probability, combined probability of over 56% of being risk on or positive growth environment has now dropped under 35%. So
Right.
we went from plus 50 to plus 30 to under plus 35. And what that's telling you, or excuse me, almost plus 60 to plus 35. So almost saw it in half. And what that's telling you is the market really steered away from that idea that growth was going to come back at least substantially, right? And I think that this is like a canary in the coal mine for the fact of when GDP gets released tomorrow, the market has already been anticipating that it's not like it's going to save the day. And more importantly, bonds well off their lows in the last month, alongside this whole destruction of growth, at least from a market pricing standpoint. So bonds are off their lows again, also solidifying that not so favorable that growth is going to come. Bonds usually tend to be right, and they're not they're not pushing lower, signaling that this growth print. I don't think the market's going to take it too well.
So likely equities will continue this downtrend that started this week.
Pretty much, yeah.
Yeah.
But I think that's where we can wrap this one up. Thank you guys for listening. If you have any questions, feel free to reach out to us on Twitter at the Market Radar.